I think we're going to go ahead and get started, so if you could please take a seat, that'd be appreciated. All right, great, thanks. So before I get started, I'll give two quick sort of logistical sort of mentions. If your table is crowded with a bunch of junk, don't worry, we're going to clear that off after, I guess, I talk. And then second, if there are folks kind of in the back or running short on room, there are some seats towards the front. You'll be able to have a better view of me and the slides, but that's about the only benefit. Yeah, that's it. So I'll introduce myself real quick. So my name is Brett Pryor. I'm one of the senior analysts with GTM Research. My focus is, well, I don't know if focus is the right word because I cover a bunch of different things. I focus on concentrating solar thermal, CSP, concentrating photovoltaics, CPV, publish reports on both of those. Project finance, which is why I'm somewhat qualified to talk a little bit about that now, and polysilicon, which is a report that I'm working on and should be out by the end of the year, assuming all goes according to plan. This is going to be about 20 minutes-ish of me kind of covering some data from our recent project finance report that should be released imminently in the next couple weeks. It's actually sponsored by Mintz Levin. It's a free report, so unlike all the other reports we're always trying to sell you, this one you don't need to pay for, so everyone in the room is welcome to review it. It's about a 50-page report covering renewable energy project finance, so it's not specific to solar, it's a little more broad. I've tried to customize some of the output to focus more on the solar space, as the folks in this room are probably a little more interested in that. But this is meant to be somewhat interactive, so if folks have like a question or if you notice errors or, well, maybe don't point out the errors, but if you do have questions, I'm welcome to kind of, you know, take those as I'm going through the slides, all right? And just to remind people, you are at the U.S. Solar Market Insight Conference. This is project finance, so if you're in the wrong place, now's your time to exit. All right, great. So the first thing here is a little map. This is not going to be super easy to see, but it will be in the slides I think we'll eventually share with all of you. This is more just to kind of give like a geographic look at where are things happening in the U.S. This is all renewable energy, so it's solar, it's wind, it's geothermal, it's biomass, that closed project finance in 2010. So you'll see it's scaled somewhat proportionally by the size of the project in megawatts. And you'll see that wind, obviously, the sort of blue turbine-y looking things, is sort of much more geographically dispersed or spread than the solar, which tends to be very focused in the bottom left corner, not surprising, and a little bit on the east, where we had a couple projects close, I think specifically a Sun Edison and a LS Power. The details of this I'll let you guys pick over when you get the slides yourselves, but this is just meant to show kind of geographically that there is a lot of spread for renewables. I'm going to talk a little bit about kind of the 2010 numbers. I realize those are pretty stale, as it's now the 11th month of 2011. But because the full calendar year hasn't closed, some of the focus here is on kind of what's happened last calendar year. This slide might not be super easy to read, so what I'll do is I'll just highlight it. The blue bars are debt. The reddish, pinkish color, whatever that color is equity. And so the bar on the left is just straight what kind of finance went into these giant projects. And then the bar on the right is, okay, breaking it down, wind, solar, other. What were the numbers? So this, again, is just to give you a sense of scale. The bottom blue bar on the left side there is debt, essentially bridge loans that will be repaid by the cash grant, which we've obviously heard a lot about. You know, might actually not be extended, in which case there'll need to be some creative ways to kind of fill that dark blue bucket with something else. The lighter blue is just more traditional debt, so that's construction and term loans. And then equity up top, which is a combination of tax equity and also traditional direct or sponsor equity. Looking at it by technology, you can see, well, if you can read this, the very bottom blue bar is wind. The next lighter blue is solar. The third is all other, so geothermal, biomass. And then again, the top red there is wind, solar, and other. So if you were to put the two solar bars together, actually, if you were to put the two wind bars together, it's about 75% of all of the dollars raised of the $18 billion that went into to projects in 2010. So it's the lion's share. Solar, on the other hand, was about $1.7 billion in debt, $1.3 billion in equity, total of about $3 billion. So sort of small-ish, but the difference is that the solar piece is growing much faster. So with that, we're going to move to solar alone. So this is solar specific. So on the the sort of left side there, you'll see the 2010 numbers. Those are the same numbers that we just saw on the previous slide, but I've now pulled out the wind, I've pulled out the geothermal, this is just solar. So around $3 billion. That's mainly one giant project. That's mainly Abengoa's Solana, which raised a massive amount of debt from the loan guarantee program and another $500 million in equity. There were some other projects, obviously, closed in 2010, but that was kind of the big one in that little bar. You notice, though, that project finance has grown by about 5x from one year to the next. This is just the giant utility scale projects and the sort of funds that have been raised by folks like Borrego, Sungevity, Solar City, Sunrun. There'll be more details on exactly what goes into these two bars. But this is not like every type of solar project. This is the bigger sort of project finance structure projects. And then the other interesting piece here is that you can see the breakdown between debt and solar committed. The debt piece is about 60%, equity about 40%. And obviously that varies by project. Some projects you have just equity, essentially. So that's the blend. Diving a little deeper into where these numbers actually came from. This table, I think, is more for you to take home, in your personal slides and review. But these are all the details on the loan guarantee projects. So this largely comes from the DOE's website. And what I will highlight here is that not all these projects are the same. So there's, let's see, a couple columns in, about the fourth column in, there's something called the FIPP. And so for folks who aren't sort of following the loan guarantee program and don't live and breathe this stuff, it stands for Financial Institution Partnership Program. And it might come as somewhat of a surprise. Generally, I think when people think of loan guarantee, you think of guaranteeing a loan. As it turns out, the majority of the dollars given out by the loan guarantee program were actually just loans, right? And so the federal government actually wrote a check. So usually you'd call that a loan. But they still call it a loan guarantee. There were some where it was a true loan guarantee, and those are the FIPP ones. So depending on how good your vision is, it was Desert Sunlight, Genesis Solar, and then the Prologis Project AMP. So those three, it's a little more complicated structure. There's a bank, somebody like Goldman or Credit Suisse or Bank of America, who provides the loan, and then there's a backstop provided by the DOE if anything goes wrong. So it's a more true kind of loan guarantee project. But the numbers here are massive, and you can kind of see those in the loan guarantee amount column. It's $11.9 billion just for these projects, and that's the debt side. The total cost, it's hard to estimate. We sort of did our own internal math to try and get at like how much of these projects cost. It was around, call it $18 billion. This is a GTM sort of research magic that happens to kind of get at that number. And then one of the things I think that's interesting, and this is sort of a topic for another day, these were done at costs that were much higher than costs that people are seeing now. These are numbers that were published for a little while and later pulled off from the public record. But these are projects that were built for $5.90 up to $7, $8 a watt. Some of that has to do with one or two of these plants having storage, but some of it is just these projects were put together back in the day when panel pricing was $4 a watt, and so all-in costs were about $6 a watt. So things have obviously changed dramatically since these projects came to fruition. So taking these numbers and kind of like looking at them by sort of who's actually putting the money in, this is the same 2011 numbers on the right and the 2010 numbers on the left. So for folks who are sort of mathematically inclined, this might be a little confusing to almost anyone else. These scales are not the same. These scales are dramatically different. The scale on the left goes from 0 to 1.8 billion. The scale on the right goes from 0 to 12 billion. So there's been a dramatic increase in the total amount of debt that's gone into solar projects. But in order to be able to see the detail, I wanted to use two different scales. I think what you notice is that there's a giant player in this market, and that's the federal government. So they have an entity called the Federal Financing Bank that officially is the entity that kind of writes the checks. So that's obviously the biggest part of this, somewhere between 70 to 80% of the debt raised by solar projects comes from them. You can see in 2010, see if my little laser pointer works, that was actually one project, right? So that was 1.45 billion that went to Abengoa's Solana. And there were a couple other projects that same year. Rabobank provided a bunch of money, not to a specific project, but to Sun Edison. I think you see Union Bank there with LS Power, and then a slew of other sort of smaller European banks that provided slugs into one big project in California called Avenal, which is actually, I think, sharp, thin film, amorphous silicon project with Urus and NRG as the developers. So that was kind of 2010. That was, last year. More interesting, and I think more relevant, is what's happened this year, right? So again, this is year to date. The year's not over, not yet at least. And so I think what you'll see again is that the FFB, the Federal Financing Bank, was the most important player, and you can see the list of all the projects there. And that was a total of about $6.8 billion. So for those of you who remember the slide previously, it was around $10 billion. The difference is that this is just the pure ones where they actually put the cash in. To get to the $10 billion number, you have to add a bunch of the bars above, the Bank of America, the Citibank, the Goldman, the BBVA, because those are all FIP programs. So they're still kind of like loan guarantees, but the cash is actually coming from the bank. So you basically can see a bunch of U.S. banks getting into project finance, whereas that space has traditionally been dominated actually by European banks who had done a lot of the wind debt. And you do still see BBVA, a Spanish bank, and Credit Suisse involved in NextEra's project. So sort of a good mix. I mean, I think one of the high-level questions that gets raised by looking at this slide is, okay, so you had 2010, FFB dominant. 2011, again, the loan guarantee program dominant. And actually, loan guarantee program is basically that whole bar, right? Because even those other names who aren't FFB, part of the reason they got involved is because those loans are guaranteed. So then the question would be, what is this going to look like next year when we do this slide, right? So the FFB is going to be zero, essentially. Who's going to fill in the gap? And is it going to be 10 billion again, or is it going to be smaller? It's going to be larger, and who exactly is going to fill that void? So that's a big question, and it sort of remains to be answered by our sort of panels that'll follow. The other piece, obviously, is the equity side. So what I've done here for simplicity's sake is to have one combined slide that looks at both direct and tax equity. They're really different things, and I think the folks in this room can answer kind of what exactly the nuanced difference is. But I think at a high level, when you think of tax equity, it's usually a player like a financial institution that is not developing the project. I think good examples of that would be somebody like JP Morgan, MetLife, Wells Fargo. Those are folks who are not developing projects per se. They're providing the equity to build them. On the other hand, direct equity is more somebody like Abengoa, who's a developer, will sometimes put in a portion of the equity in order to get it built. And BrightSource is another player that often they'll provide a certain amount of the equity, and that is either called sponsor or direct equity. So again, just to highlight, these scales are not the same, right? There was a massive bump up in the amount of projects that got done in 2011. So on the left, this is around that $1.3 billion amount, and on the right, it's around the $7 billion amount. So, something like a 5x increase. So, again, to show the detail, I've expanded the one scale to make it, look a little bit more important than it is. The 2010 number, though, again, it was dominated somewhat by that Abengoa project. So Solana, they effectively put in, as far as we can tell, all the equity, which was around $500 million. And then you'll see, a number of other players. PG&E Corp is one of the sponsors of this conference, and they're actually also a tax equity provider. So it's a slightly complicated structure, and I might leave it up to the PG&E people to explain, but it's not PG&E, the utility that provides that money, it's PG&E Corp. And so there's a distinction and a different logo accordingly. They put money into both SolarCity and Sunrun funds to the tune of about $300 million. You see Wells Fargo on there. They invested in a large GCL fund. Bank of America, MetLife, one of the big insurance companies, put money into, that's actually a specific project, SunEdison's Davidson. JP Morgan's on there with SunEdison Fund. Might be hard to read beyond that, but you have US Bank, NRG, and East West Bank. So that's last year. Moving sort of forward a bit to kind of current sort of history, you can see 2011. It's kind of interesting, I think, in that there's been a real reshuffling of the names. So, you don't see Abengoa, you do a little bit, but much smaller. PG&E Corp not as big, Wells Fargo not as big. You basically had a different category of investor, kind of the IPPs, really step forward and put huge amounts of money to work. And where this actually happened is these are largely the loan guarantee projects, where essentially the developer pushed it up until the sort of like near completion. They get the loan guarantee all basically buttoned down, and then on the day that they finalize it, the project is officially purchased by another entity. So, a couple examples of that. SunPower's California Valley Solar Ranch had a similar transaction with NRG. NextEra's Desert Sunlight investment was similar. Exelon's acquisition of Antelope Valley was similar. It's essentially structured in a way that they essentially are on board and kind of come in and provide the cash to be that equity slug to build these giant projects. GE also played a similar role, again, for First Solar's Desert Sunlight. You do again see ebb and go on here. My sense here is that, and this is a little bit of speculation, I think as a developer, you'd always prefer to have someone else provide the cash for your equity investment so that you can focus on doing what you do, which is developing projects. Because Abengoa, I think, has the ability to finance on their own, I think that's likely why they're providing the funding for both Solana and also Mojave Solar. And then potentially there'd be a buyer down the road who would cash them out once those projects are built. That's actually what happened with Nevada Solar One, which was one of the largest solar projects built in the U.S., with Acciona essentially funding it through construction. You also see Sempra, which received a loan guarantee for its Mesquite Solar One. The one correction on here, Solar Reserve is listed. It's actually a combination of Solar Reserve and Santander, the Spanish bank who put in the equity for their Crescent Dunes plant, and then Wells Fargo, and then a player that normally gets much bigger billing, Google, which made a lot of sort of headlines when it announced it was going to be putting some money into a solar project. In the grand scheme of things, it doesn't look like a very big dollar amount, the 168, but I think it's more important because of the category that Google's in, right? So whereas NRG is a power sort of producer, NextEra, Exelon, these are companies that have all been in this space, are all very familiar with it. With Google, obviously they're a heavy electricity user, but it's interesting because of the precedent it sets, that maybe we will see more non-energy companies coming into this space and providing tax equity. We, are going to have a panel in a little bit which will discuss exactly the issue of, is this going to be a bottleneck? Part of what has happened up till now has been that when you build a solar project, the 30% comes as a cash grant that is likely or is possibly going to change if it's not extended, in that you'll essentially get a tax credit. So what that means is that in 2011, we've had around $7 billion of tax equity go in, and some direct equity, obviously. And that was just to kind of like, cover the non-cash grant portion. If the cash grant's not extended, you're going to have a much bigger amount that's going to need to be financed via tax equity. So there's likely going to be a supply-demand imbalance, but that remains to be seen. The last slide actually, again, might be hard to read, and this will be in your email that you'll eventually get with the full slides. But this is meant to kind of get at the question that we always hear, which is, what are the rates, right? So starting at the bottom, what we've tried to do here is look at wind, solar, and that's broken down PV and CSP. What are rates that people are actually achieving when they go out to the markets and either raise floating debt, fixed debt, and then the more magical and difficult to estimate stuff, the tax equity rates and the sponsor equity rates. So it should be noted that the two bottom categories are publicly available, right? So people will publish, what rates they achieved on a financing if, they raise floating debt. Same with fixed debt. Any of those top four categories, though, those are our own kind of in-house estimates. And so those are not precise. They're very deal specific. And, unfortunately, they're not scientific. It's not like what price is IBM's stock trading at. These are somewhat complicated things, and it's hard to actually pin down, exactly the right range to look at. But we do want to have some numbers here. So starting just quickly at the bottom, you'll see floating debt. The numbers here come from, public sources. So you'll see LIBOR plus somewhere between 175 to 325 bips for wind projects. Solar's in about that same range. And you'll also see the term there. We've seen ranging, construction and term debt from 4 up to 22 years. That 22 years seems quite long. That was actually for a CSP project not in the US, but it was one of the only ones that did receive financing, and that was in Abu Dhabi. Fixed debt, you'll see the one at the bottom there around 5%, that's a bridge loan, so that's a short-term loan. The 5 3/4 to 7 1/4 is, again, for wind, somewhere between 7 and 25 years. And beyond that, you'll see the green and blue bars for PV and CSP, a little bit higher than wind, although, even that is somewhat debatable. It sort of depends on who you talk to. Tax equity numbers, these are harder, and we'll talk a little about these on our tax equity panel, but I think what you're seeing here is, unlevered, high single digits. One of the questions that'll come up is, where is that going to go, right? That was the sort of range. It's possible that if you have, a lot more projects seeking tax equity and not a whole lot of new entrants to that market, there might be a supply-demand push that actually pushes those rates higher. There's the levered rates, which are usually a couple hundred bips higher. That's a sort of a complicated sort of question. It depends on how much leverage there is. And then the direct and sponsor equity, here we've tried to break it down in terms of like some folks are actually in it for the long haul. Some folks are more looking to kind of get in and out. So that we're calling development. There's a range here too. These are probably the hardest numbers. There's also like different structures as to how the developers got paid. But the sort of numbers that we hear are somewhere between, call it 8 and 15% returns for developers. So I'm almost out of time. I was going to see if there's any real quick questions that people want to ask before we jump into our finance panel and our tax equity panel. So I think we have a microphone somewhere in the back. Did anyone have any specific questions on any of the stuff that I just went through? I got one right here, so maybe you can get a mic to him.
I've had a bit of a challenging time figuring out what these financing deals look like. Specifically, I guess, since it's the federal government actually funding the loans for Agua Caliente and Antelope Valley, is it out there that that's 15-year, 3.5% money? It's, can we FOIA that and figure it out? And then on the flip side, where you have the FIPP, Citi and Goldman float that. Was that a term loan? Did they do a asset-backed security? How are these things getting done in the capital markets on the big projects?
Yeah, no, I mean, it's a good question. I think it might be worth me following up directly with you on that because it is a somewhat complicated answer. But I think at a high level, there has been some documentation that's come out from the loan guarantee program regarding interest rates. I think it was somewhat connected to the Solyndra issue, right, as to exactly what they were paying. My sense is that you could dig around a little bit. I think it's probably in the neighborhood of 4 to 5% is kind of what folks are paying for loan guarantee loans. I'd be curious if someone in the room knows better or otherwise, and maybe we'll hear that on one of the panels.
I mean, I guess the key question is, since the loan guarantee is gone, take a project that looks a lot like an Antelope Valley or a lot like a Desert Sunlight that hasn't been sold to an NRG or an Exelon yet. How much more expensive is the financing this go around? How many more basis points are they going to have to pay because the federal government's not standing behind the debt?
Yeah. No, I think it's going to come back to sort of the fixed debt rates and the floating debt rates that we've seen for wind, right? Assuming that there's a similar risk profile for these large solar projects. If the wind guys can get LIBOR plus, 200 bips, it's probably going to be in that same realm. If you want it fixed, there's ways to kind of, make that happen. But you're probably talking in the 7 to 8% range, which is quite a bit more than when you have the government backstopping it. So actually, we're going to wrap up there. We're now going to have our first panel come on up. So if you need to grab like a quick drink, please do so. We're going to have our panelists get up here, and we'll get started in a couple minutes. Thank you.